growth accelerating, inflation cooling, and a market shift that could catch many investors off guard. According to my next guest, 2026 is already setting up to look very different than 2025. So, is the AI trade showing any signs of fatigue? Are there new opportunities emerging in places that the street hasn't fully priced in yet? And what about the state and direction of the U.S. economy? We've got a lot to get into right now on this episode of UBS Trending. Hi, everyone, and thank you so much for joining me. My name is Anthony Pastori, and this is UBS Trending. In the studio with me is my guest, and I'm always happy when he's here with us, co-founder and CEO of Key Advisors Wealth Management, Eddie Gabor. Eddie, thanks for joining us. Good to see you.
Having me today.
Great to have you. So, as we kick off 2026, I thought we'd start with sort of a general question. There's a lot that's happening in the markets, even in just the first month of the year. We're just entering February here. We've already had a Fed meeting. We already see that the Fed is remaining data dependent. We're going to get into that in a minute. Just give us your overall outlook on the markets and the economy as we stand right now, just entering the 2026 calendar year.
So our theme for 2026 was bet on the U.S. economy. A lot of these economically sensitive areas have been left for dead the last 2 years because of the AI trade. And when we look at the macro environment, with the worst behind us, with tariffs and all the fears that we had last year, going into this year, we feel like the economy is going to really accelerate, surprise to the upside. And we're a big believer in listening to what the markets are telling us because they're very forward looking. And when you look at all these economically sensitive areas, they are in a bull market right now. January was a phenomenal month for them. And so we expect that to continue to accelerate. And we think more and more money flows will go into those areas that we are overweight as the year goes on and the economic data comes in.
Yeah, it's interesting because even when you look at November and December, inflation print was cooler. And so I know that's one of your theses is that you expect to see inflation continue to kind of cool as the year progresses. Does that give you any kind of sense of where the Fed might go?
The Fed right now, I don't know if Powell will cut maybe one time max. I think that's
Before he leaves his seat.
correct.
Right.
But they are accommodative enough right now, in my opinion, because they're kind of doing a mini QE. They don't want to call it that. But at the end of the day, with the growth being as strong as it is economically, they don't have to do too much as long as inflation and it comes down. And we expect it to, because when we look at housing and rents and energy prices have come down, that keeps the 10-year bond tame. The 10-year bond is a lot more important than the Fed, in our opinion, in regards to the direction of markets. So as long as that 10-year bond cooperates with us, it will stay bullish in these areas. So that's the biggest risk we think we have to the market, is that the bond market does not cooperate with us.
Right. Yeah, because we're looking at 10-year treasury yields on the rise since January 13th or 14th, when the first news of Iran and Venezuela, and although the sort of geopolitical risks were heightened again, after being pretty range bound for most of the last month and a half of last year between a 4.12 and a 4.15 rate. So it's interesting to see now how the treasuries are really reacting to market developments and geopolitical developments so quickly.
Yeah, these markets move fast. And
Yeah.
for us, that 4.5 number on the 10-year is a big number, because psychologically, if we get to that point, the markets won't like it. It'll readjust to it, but initially they won't like it. But we think the 10-year has a chance to actually trend down over the next 2 to 3 months. We think the January and February CPI data will show a cooling, and that should satisfy the bond market.
Excellent. I want to get into this AI story. I mean, it is the story. It's been the story for the last 2 years. It continues to be a story. But you've got this sort of idea, or sense, looking at your research, that AI, the story might be cooling a little bit. I know I'm oversimplifying it. Tell us what you mean by that.
So AI and technology, especially software, it's heading into a bear market. So our thesis was, for technology coming in 2026, their earnings expectations, the bar was set so high, it's really hard for them to beat. And this is why you're seeing post earnings, a lot of these companies, they're showing solid earnings, but they're starting to show a deceleration of CapEx spending. And your first guide down is never your last guide down. So we think that technology is going to really suffer here over the next few months, especially the ones with the highest valuations. We learned last year how fast these markets can go down on the technology side. So we have been selling technology, especially the software space, and continuing to go in that rotational trade that we think is going to continue to catch momentum.
Right. And the S&P 500 for the last 2 years really was overweighted as successfully by the Mag 7 and the Mag 5, whatever the top 5 or 7 technology companies were, do you anticipate that if we do see this correction that you're anticipating, that other sectors will help lift the rest of the index? Because it'd be interesting to see if you take all of that out, where we end up.
Yeah, I think the broad market could start to suffer a little bit. I don't see like a big correction in the broader market because I think the other areas like the industrials and the financials and I think small caps and other areas like that
Yeah,
will actually do well. But there's no, when you look at the concentration in the indexes, it's hard if you start to have the Mag 7 go into a bear market for it not to impact the S&P
of
500.
course.
But I think you're going to see a big divergence where tech is going to really be much um, underappreciated from the sense of it's going to be going down much more than the other markets.
Yeah, we at CI in our chief investment office, there's a report out called The Great Broadening, and it's talking about broadening your investment opportunities and saying that AI still has room to grow, but more on the application side, less on the infrastructure side. And obviously, there's still AI adjacent sectors like utilities and energy, and even think about consumer like things like consumer discretionary. Those kind of areas. If you're talking about the fact that we talk about the one big beautiful bill and how it's going to look like it might put money into people's pockets this year, they're going to start maybe doing renovations on their homes and all these things that step outside of sort of the AI story. So not unlike what you're thinking, our thesis is slightly different, but close to what you're saying is start to look at a different way to invest in AI. And there are other sectors that have opportunities that have yet to be tapped into.
Yeah, I couldn't agree more. And look, I think this broadening out is a really healthy thing. This concentration in tech, it's not healthy from a market perspective.
Right.
That's always been our concern. So this broadening out is very bullish on the margins. But if you're going into this year heavy tech and you're not willing to sell any, you're going to probably feel quite a bit of pain. But these corrections are very healthy. AI is not going away. These are some really solid companies. But sometimes you need a 30 to 40% drop to get back to normal valuations.
Mm.
We think technology opportunities will be huge later in 2026. In the meantime, we're sticking with that broadening theme because we do think we're going to continue to see this market surprise to the upside on the economically sensitive
Good to
areas.
hear it. And just before we wrap up, Eddie, just you mentioned small caps. I know we've talked about that on the show before. I know you're still a fan. What other areas would you say investors could be putting their money to work in 2026?
We really like home builders, and that is not a consensus call right now.
Hmm.
And they are off to a really good start this year. Industrials as well too. When you look at industrial ETFs, you look at some of the other ETFs that are economically sensitive. They're up 8-9%
Yeah.
just for the month of January versus where we are with tech, which is flattened down in some areas. So I think you're going to continue to see this outperformance. And lastly, because of the concentration in tech, to chase that trade, you're going to have the institutions are going to have to sell technology and rotate into this. So industrials, small caps, regional banks, we love them right now.
Excellent. And even with potentially mortgage rates, 30-year mortgage rates rising a little bit, if we do see a rise in treasury yields, you still think there's room on the home builder side? People are going to still be buying homes.
We've been underbuilding for a while now, so
Yeah.
there's an inventory issue. And this administration has pretty much said they're going to try to do everything they can to revive the housing market. So I believe that they will put some type of policy in place. And I think the home builder stocks are sniffing it out, which is why they're up so much.
Excellent. Eddie, love having you, man. It's always nice to have you join me in the studio.
Thanks.
Please come back anytime.
Absolutely.
Good to see you. Thanks, Eddie Gabor. And thank you all for joining us. If you'd like more information on anything that we discussed today, please visit our Insights website at ubs.com/views. Plus, you can follow UBS on social media. We're on LinkedIn and Facebook, as well as Instagram. We've got a dedicated channel for the studio at UBS Trending. Lots of great content there for you. And of course, if you would like to continue this conversation, we recommend that you continue it with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everybody. And remember to keep your eyes on what's trending. We'll see you soon.